Even with the slight recovery we saw on Friday, the S&P 500 has still shedded over $3 trillion in November, and crypto hasn't been spared either. Roughly 1/3 of the entire market cap has been wiped out, and the Fear and Greed Index plunged down to single-digit Liberation Day lows of 6 to only reclaim a little bit higher at the end of the week at 11, still deep in extreme fear. Now, just this month alone, we've watched double-digit drops from some of the market's most popular names, and now a real question is emerging. How long can this AI rally actually last, or is the bubble already starting to slowly deflate? We do also need to just bring investors back down to earth. If we look year to date, many companies are still up strong double digit. What's very interesting though, and honestly worrying, is what happened last week with Nvidia. We can see, despite reporting a double beat where they posted strong year-on-year as well as quarter-on-quarter growth, we can even see data center that was up 66% year-on-year, and also the fact that they raised their guidance significantly above what the market was expecting. The markets ultimately barely held their ground. Now we have a leaked internal memo showing CEO Jensen Huang stressing that the entire world is leaning on Nvidia to keep the AI narrative alive, because if they don't, the bubble will burst. We can see here, he said, if we delivered a bad quarter, which as we just saw from the numbers, they did not, it is evidence that there is an AI bubble. If we delivered a great quarter, which we saw, we are fueling the AI bubble. And he's even admitting here that expectations for Nvidia continue to be incredibly high, that he believes they are in a bit of a no-win situation. And he's saying if we had delivered a bad quarter, if we were off by just a hair, if it just looked a little bit creaky, the whole world would have fallen apart. There's no question about that. He even goes on to point out that he has looked at some of the memes that are on the internet and says that we're basically holding the planet together, and he's saying in his own words, it's not untrue. Now that's pretty damning evidence that if the AI bubble is solely relying on Nvidia quarter on quarter to report a strong earnings, then if we even see in an upcoming quarter a bit of weakness, then the market will be in trouble. Some investors, some analysts believe this is only a matter of time. And maybe this is something you also believe, because when we look at valuations, they still look very stretched. This is both on a forward P basis as well as incorporating growth on a PEG, so the pressure does look very real. Now ultimately, the biggest shock to the markets came from the Federal Reserve. The hopes for a December rate cut were rattled when the Fed signaled things aren't as clear-cut as investors really wanted to see, pushing the probability of a December rate cut all the way down to 25%. We even have Morgan Stanley, who now thinks we won't see a cut in December whatsoever, and instead they're predicting 3 rate cuts in 2026. They see one in January, April and June, bringing down the interest rate to around 3 to 3.25%. But we did get a shift in tone on Friday. One Fed president hinted there may be room for a near-term cut. That helped fuel the small rebound that we saw on Friday. But on the other hand, we have Fed officials saying there's no urgency to move, which is only adding further confusion and further volatility to the market. Now, what makes this very complicated is the October economic data is extremely limited, and what information we do ultimately have won't even be released until December the 18th. That is after the Fed meeting, and that means the markets are likely to remain volatile in the coming weeks. But volatility creates opportunity, and today we're breaking down a few stocks that we believe are either generally severely undervalued or look like great opportunities to add if we do see further weakness across the markets. So stock number one we're looking at is Visa, where it's up only 6% in the last year. Year to date up only 4%. On both accounts they've underperformed the S&P, but if we zoom out to the last 10 years, they have ultimately outperformed, up 311%, trading towards the lower end of the 52-week range. And whilst we do get a double hold from Seeking Alpha and Quant, Wall Street at 4.4 out of 5, very near the 4.5 to ultimately flip that into a strong buy rating. Now their forward P at 25.6 is below the 5-year average at 27.3, so straight away, remember though, we don't look at this in isolation. This does give us a potential undervaluation signal. For those that want to see the lowest point in the last 5 years, well, it was around the back end of 2022 at a forward P of 23.5. And if we look at the blue tunnel, which signals the fair value, the intrinsic price, we can see it is sitting right there towards the bottom end, indicating potential undervaluation. Do bear in mind, you can always tell high quality stocks because we run through a lot on this channel. Many of them enter into deep, severe undervaluation signal during the Liberation Day drops. For Visa, that was not the case, and in fact, over the last year, it's pretty much trended in a reasonable signal. Tells you this one doesn't that often fall into undervaluation, which is also confirmed when we zoom out to the last 10 years. There are notably a handful of times where we do see this in a severely undervalued position. Most notably was around the back end of 2022. Otherwise, the discounts that are on offer for this high quality company are very rare and very limited. And if you want to see the valuation grading, well, they get an F because ultimately their forward P does sit above the sector, so you're paying a triple digit premium. As always, for newer viewers, sector median has a lot of low quality companies. Visa does deserve a premium, deserves to be at the upper end. Question is this premium worth paying today? And as we just pinpointed, against their own 5-year average, they're trading at a discount of around 15%. Price to earnings growth, nice to see it below 2. That is really where things for us start to get a bit interesting. Although, as we can see, like the forward P, you are paying a premium. And actually, Visa are now trading in line on a PG basis than that they have done in the last 5 years. Now, for each one of these companies, we'll tell you our intrinsic price, where for Visa, we have $409. Although, bear in mind, this is actually on the more conservative side, where we've used a growth rate of 10%. Typically, we use the medium one. This is really just to point out that Visa does look like an incredibly great opportunity for longer-term investors. Now, we do have low, medium, high, 10, 12, 14, where, as always, the numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Visa or any others. But what's quite important when we do look at companies, reverse DCF 6.9%. If you're buying tomorrow at 327, that is what is baked in into the long-term growth of the future free cash flows. As an investor, if you believe that is very low, then straight away undervalued opportunity. The opposite also holds true. If you believe Visa will grow less, which is very unlikely, then ultimately overvalued. So using the growth rate and the discount rate gives us the present value of the future free cash flow terminal price. Add together with the cash, subtract total debt, gets the equity value, divide by the shares outstanding, 409 on the lower end today, 25% upside. Typically though, we do use the middle rate at 12%, 472, 44% upside, which is really where we would say the intrinsic value holds for Visa today. If you also want to see, for transparency, at 14%, 544, 66% upside, but we're not done there. We'll show you both low, medium and high, kicking off at a 10% growth rate moving forwards. The margin of safety on offer today sits at 20%, where typically on the channel we would start off at 10%, execute buy if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, which you could argue Visa holds all 3. Therefore, a 20% MOS could be a great opportunity to consider the company. If you want 25, a buy at 307, and at 30, a buy at 286. Wall Street themselves see $410 into next year, 25% upside. So let us know your views on Visa, whether it's one to consider this week, whether we get weakness, or in fact just a great opportunity to start. And using the middle rate of 12%, well, MOS much higher naturally, sitting at 31%. And if you believe no, they will grow even faster at 14, which is actually less than the most recent year, then MOS sits even higher at 40%. But let us know, stock number 1 Visa, is it a buy, hold, or complete avoid. Before we continue, we want to let you know we have released our latest free weekly article covering quality stocks to buy the dip before the market rotation ends. We drop one every single Monday morning to your inbox covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is the Kroger company, up 13% in the last year, year to date up 8%. Over the last 10, it is up around 74%, so it has slightly underperformed the S&P, trading around the mid to low end of the 52-week range. We get a fairly rare triple buy rating across the board, although they're not the strongest. We're seeing on average around 4 out of 5, and it trades pretty much around the forward P of the 5-year average, 13 today, historically 12.4. Yield is also very similar, so you could argue on both accounts Kroger looks reasonably valued. Where if we take a look at the blue tunnel, we can see again, like Visa, this one never entered into an undervalued opportunity, not in the last 12 months and not even during the Liberation Day lows, so perhaps another sign of a high quality company. Today though, in the blue tunnel, meaning again reasonable valuation, where when we zoom out to the last 10 years, actually this one has had quite a number of times where it's traded at a discount overall. The other thing to bear in mind, companies you want to add, we should see the intrinsic price over time in that upwards momentum. You don't really want to see companies that are decreasing, although that is something just worth considering. Maybe you believe those type of companies could be turnaround value plays. And the valuation grade at a C, they're trading at around an 11% discount overall to the sector, a slight premium of 12% to their 5-year average. And whilst price to earnings growth isn't compatible for stocks that aren't fast growing, we'll highlight here 2.17, 17% discount to the sector, but actually against their own 5-year, a 20% premium. Now our intrinsic value at $76 is the average of the 3 models, although we'll flag on a DCF, if you solely want to look at that, we've used 10% moving forwards in terms of the growth rate. Baked in today on the current value at $66 is 8.8%. Will give you a good idea about where you see the company. So for Kroger, we see a 13% margin of safety. Maybe naturally you want a bit more. So at 20%, if you want to make note, a buy at $61. At 25, a buy at 57, and at 30, a buy at 53. Wall Street themselves see $82 into next year, 24% upside, so they do believe this is one for serious consideration. But give us your views on Kroger today. We then move on to a company that's similar to Waste Management that we covered at its 52-week low, which has seemed to start to recover. We're looking at Waste Connections, down 7% in the last year, up only 2% year to date, but over the last 10 years, massively outperformed the S&P, up 618%, trading towards their 52-week lows. We get a very weak buy rating from Seeking Alpha, a hold from Quant, but a very, very near strong buy from Wall Street, 4.48 out of 5, 4.5 again for that strong buy, where we notice in isolation, even below the 5-year average, it looks at a very high price, 31.7, but given the average sits above, this is again another undervaluation signal. The lowest, in fact, it's been in the last 5 years for just one point in time was sitting around the 26, 27 forward PE. And on the blue tunnel, we get that undervaluation signal. It is sitting just below the bottom end, or in fact, just within. We can see in the last few weeks, one that we covered actually when it was around $10 cheap. Well, when we zoom out to the last 10 years, this one incredibly rare to see it in severe undervaluation. In fact, just one time noted, the back end of 2023, otherwise that's not noticed in the period. And also blue tunnel moving in the right direction, as always, great to note. Now the grading at an F, they're trading a 72% premium to the sector, slight discount to their 5-year average. Price to earnings growth 3.2, again not applicable, but we'll highlight it for consistency. 80% premium to the sector. More importantly though, against their 5-year average, not too dissimilar, sitting around 5% higher. Now intrinsic value, $193 is the average, although we will flag on a DCF, it does sit much, much higher. We've used 10% moving forwards, baked in today sits at around 6.3, and if we were to use all three, you're still getting a near 10% MOS. If you want a 15, a buy at 164, at 20%, a buy at 154, 25, 145, and at 30%, $135. Wall Street themselves see $210 into next year, 20% upside, so let us know on Waste Connections, is it a buy, hold, or one to avoid? We then move on to Mastercard, another very high quality company, up 5% in the last year, up only 3 year to date. Over the last 10, massive outperformer once again, up 448%, trading around the midpoint of the 52-week range, where we get a weak buy from Seeking Alpha, a hold from Quant, and another near strong buy from Wall Street. Now this one, forward P, again you could say that is high in isolation at 29.4, but actually lower than their 5 year at 32.6. Lowest it's been around that 27 mark at the back end of 2022, and we can notice another undervaluation signal just below the bottom end. In fact, it was slightly below just a few days ago, but still around that point. And over the last 5 years, we can see a couple of times where this one was in severe undervaluation. But companies like Mastercard, when you do note that, that is the time to really grab the opportunity by both hands. If we see this show further weakness, maybe again something to think about, but great to see Blue Tunnel moving in the right direction. Now another F1 valuation, triple digit premium to the sector, near 10% discount to their 5 year. Price to earnings growth, interestingly, it is higher than what we saw from Visa, just below 2.26, triple digit premium to the sector, but their own 5 year average slightly lower at 1.94, hence the 17% premium. Now our intrinsic price $640, where in fact we've used the middle growth rate of 14%. You'll notice in comparison to Visa, these are slightly higher, as overall Mastercard does grow faster, but on a reverse DCF, this is higher than Visa, which was around the 7%, currently around 11.4. So using the middle rate of 14%, 19% upside, you can see if you believe 12%, well, upside is in fact very limited. We're talking 3%, sitting on average as the 10 year at 16, well, a lot higher, around 36. So if we use the middle rate of 14, ultimately we're seeing a 16% MOS, which could be very attractive for a very high quality company. At 20%, a buy at 512, at 25, 480, and at 30, 448. Now actually, if you believe we should use in line with their 10 year at 16, then ultimately you're seeing a very attractive MOS at 27%. Wall Street themselves see $690 into next year, 28% upside. Let us know, maybe you prefer Visa, maybe you bought both, or in fact, you believe these are ones to seriously avoid. Give us your thoughts below. We then move into the semiconductor space, and this is one for consideration. If you believe the AI rally will continue, we're not sitting in a bubble. Nvidia up 22% in the last year, 33% year to date. Over the last 10 years, probably one of the best performing companies, up 22,695%. Now it's still trading at the upper end of the 52-week range, but on a pullback from all-time high at $212, where we notice a hold, although near 3.5 to flip to a buy from Quant, weak buy rating from Seek Alpha, and a strong buy from Wall Street. Now their forward P very low at 26.1 if you believe the numbers they're projecting moving forwards. 5 year average much higher at 39.4, and actually this is one of the lowest in the last 5 years. The bottom did sit beginning of 2024 around 25, so something for consideration there. And on the Blue Tunnel, we can in fact see this company's intrinsic value quarter on quarter only seems to be going higher and higher. Nice to see the share price actually drop, especially for those who are longer term investors and want to take advantage. But you can see pretty much all of 2025, this one's been trading severely undervalued. Well, when we zoom out to the last 10 years, really this undervaluation started from 2024 and then at the beginning of 2025. Otherwise, this one more often than not does trade in the reasonable signal. Now an F on the valuation, 70% premium to the sector, but you could argue they are the best, if not one of those in the sector overall. 17% discount to their 5 year. Price to earnings growth now sits pretty much around 1. That is what we would call a screaming opportunity. Again, if you like this, it fits in your portfolio, you do have a strong investment thesis, and it's a 36% discount to the sector. Historically, on average, their price to earnings growth sits at 1.65, so you're getting a 38% discount, and our updated intrinsic value comes to $186. Now, what we've done here is updated the 2026 future free cash flow, where we've ultimately used the quarter 1, 2, and 3 of 2026 and extrapolated that for the full year. So this does look a little bit more accurate than last time. Now, based on a reverse DCF, still very high at 19.3. If you believe 20%, well, you are getting upside, very minimal. If you believe these numbers are way too low, well, look, at 25%, $249 price target, 40% upside. So if we use the 20%, what you will notice, you are getting a margin of safety today, but not that much at 4%. Maybe that's enough. Maybe you want a dollar cost average. At 10%, a buy at 167. At 20%, a buy at 149. At 25, 139. And 30%, 130. Now, Wall Street themselves see $258 into next year. Very, very bullish, as they have been consistently. 45% upside. And what's interesting, because if we use the 25% growth rate moving forwards, that comes to $249. Wall Street actually have a price higher. They believe Nvidia will grow faster than the higher rate of 25 today, which means if you're in agreement, you are looking at more than a 29% MOS. So give us your thoughts on Nvidia, buy, hold, maybe one in fact, just to completely avoid, and you believe the AI bubble is soon about to pop. We then move to a completely different industry, the tobacco space, with Philip Morris. Now this one's interesting. It doesn't look severely undervalued, but if you want to gain some exposure here, you like the yield, we will run through the price targets. It is up 18% in the last year, year to date up 29%. Over the last 10, it has underperformed the S&P, up 78%, although it is on a pullback from all-time highs at $187, where today it sits right there in the midpoint. Now we get a triple buy again, second time today, although weak from Seeking Alpha from Quant. Wall Street, another near strong buy at 4.3 out of 5. And we can see the forward P now sits at 19, which for the tobacco space does look a little bit high, although it has come down from the highs of 24, above also the 5-year average of 16, where you'll notice here the yield at 3.8% is below the 5-year, around 5.1. This one peaked a few times in the period at around 6%, but we will flag for those that are interested for this higher yield today, the dividend does look to be safe at a score of 70, and they increased the dividend by around 9% just a few months ago. And when we do take a look at the blue tunnel, again, nice to see it increasing, even if it is slightly, but we do note the disparity there at the upper end, so slight overvaluation, but it has come down from the highs that we saw earlier. And if we zoom out to the last 10 years, you can notice Philip Morris has given investors the opportunity to buy this undervalued before, and valuation at a C-, 32% premium to the sector, and also 19% premium to their 5-year average. Where if we look at the price to earnings growth, 1.83, actually a 30% discount to the sector, and the fact that it's below their 5-year does show growth looks to be strong, a 4% discount. We typically do go through these other factors, but today we're just looking purely at valuation. Philip Morris, B- on growth, A+ on profitability, where our intrinsic price at $165 is using a growth rate of 8%. Today, baked in is around 7.2, so you'll notice if you believe it to be in line at 6, there's actually still downside of 10%. If you believe they will grow fast at 10% moving forwards, then ultimately you're seeing 26% upside. So if we use the middle rate at 8%, you'll notice an MOS, but on the smaller scale of 6%. At 10%, a buy at 148. At 20%, a buy at 132, and at 30, a buy at 115. Having said all of that, Wall Street with their near strong buy ratings see this at $186 into next year, 20% upside. Is Philip Morris, in your views, a buy, hold, or one that maybe you just don't like the industry? We then move on to Salesforce, which is probably one of those stocks alongside Novo Nordisk that just doesn't seem to get a break in the market. They're down 32% over the last year, 32% also year to date. Over the last 10 years, they've still managed to somehow perform roughly in line with the S&P, where they're trading pretty much around 52-week lows. Now we get a buy rating from Seeking Alpha and a hold from Quant, another near strong buy from Wall Street today, where their forward P sits at 19.1, not only well below the 5-year at around 30, but look at that, it peaked around 76 at the beginning of 2022, and we also notice severe undervaluation, massive disparity between where the company is valued at today and the bottom end of the blue tunnel. Although the first one we've covered, where the blue tunnel has been decreasing slightly, not something we particularly like. And if we zoom out to the last 10 years, well, this one actually seems to be a company that constantly trades at a discount overall to its intrinsic price, and you can see it peaked around 2024. So this is one where we do need to see things change over the next few quarters. You could argue though, given the valuation, this is one for serious note. At a D overall on that valuation grade, 11% discount to the sector, 46% discount to their 5-year average, and price to earnings growth, I do believe the second best one we've covered today, just behind Nvidia, 1.16, 27% discount to the sector, 42% discount to their 5-year, where price to earnings growth historically sits at 2. Now our intrinsic price gets to $369, which is using a growth rate of 8%. Now, given the continuation of the sell-off on a reverse DCF, Salesforce is estimating 1.1% growth moving forwards. That is at the current market price. If you believe actually these numbers are too low and management are in fact targeting double-digit growth, then you could be looking at more than a double, 115% at that 12% level. If that's what you agree, well, you're looking at a 54% margin of safety, making it look extremely attractive. But you also have to consider whether or not you believe the narrative that AI is really going to harm this company, or in fact you see this as a benefactor overall. Using the middle 10% rate, well, then you're still getting a very strong MOS at 47%. And if you want to be very conservative, use the 8%, well, look, still attractive, 39%. Wall Street themselves also see massive upside into next year, 335 target price, 48% upside. But give us your views, is Salesforce a massively strong buy right now? Maybe one actually a strong sell. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.